All right. What is up, Hot Take Nation? I'm actually really surprised that has stuck. I don't know why. I just can't come up with anything else. So it is DRW here in the house, literally in the house, shag carpet and all. Producer Glenn is also here. We were doing a little mic check before we got on, and I said, Glenn, I really like that volume. What did you say?
Yeah, I was like, well, I'm not talking yet, David.
Yeah, exactly. So I like the volume where I can hear myself and I can't hear anybody else.
Nice.
But you know what, Glenn, if we're honest, and today is a very special edition. This is the Emergency SMOG podcast because, you know, I don't know if you've noticed, but I have the microphone, I have a podcast, and everyone on Twitter can go fuck themselves.
Yeah, I have noticed that. And you stirred up quite a little hornet's nest in your methodology around valuation. Would you say?
I did. And what's amazing is how can it be, on the one hand, the most worthless POS method of valuation that's lazy, and on the other hand, be called financially irresponsible to point investors to the back pages of the annual report? I'm in shock. So as a result, we're having a podcast on it. Glenn, why don't you give us a catch up on what happened on Saturday night?
Okay. You got into a Twitter kerfuffle. If people aren't following David Ramsden Wood on Twitter, please do so. And you'll see there's a little bit of back and forth, and it really stems from your reiteration of your valuation of companies, right?
Yeah.
And utilizing of SMOG in particular.
Yeah.
And people taking objection to that, and
anonymous people taking objection. Which, look, I get it. People are afraid to get fired. They don't want to use their real name. They have a job, and people don't understand social media. But that's the thing. If I'm honest, that's the thing I hate about Twitter is you can sign up with some anonymous, GFY. Handle, and then just start like ripping people, and you don't have to be held accountable for the shit you're saying. I appreciate it. I will say there were a lot of DMs in support, and they were actually introducing themselves with their real name. So that was cool. And again, I get it. But like big tough people using an anonymous handle to say whatever the fuck they want. Really cool. Really cool. I'm going to go with I really value the people whose name I know and stand behind the shit they say, which is why I use @David Ramsden Wood as my my handle, and I post the shit I post on LinkedIn because I'm not afraid to say it.
Let's get a little bit more into it, and you and I have had this discussion where, even I am like, really, you're going to use the SMOG? Because in my career, majority of my career has been in financial services, some in oil and gas directly, but, and I'm not an institutional investor, but in my time with, certainly with Intercom, as well as prior to that, these are all the people that I've dealt with, and never once have I run across where people are like, yeah, I'm going to use this valuation for SMOG, and they all have different, but yet similar ways of valuing companies. And my first question for you was, all right, if you're looking at SMOG, all right, let's just, is it something that you would make as applicable across different market caps, right? In other words, you certainly value small cap firms differently than mid cap than large cap. Would you agree with that?
Yeah. So yes and no. First, for the listeners who don't know really anything about what we're talking about, SMOG is the standardized measure of oil and gas. It is reported once a year. Unfortunately, I think it should be reported far more frequently than that. But it is reported once a year in your annual report, and you can basically open any PDF, hit Control F, and then type in the word standardized, and it will bring you to the company presentation of effectively their 5-year development model, their PDP cash flow at a SEC mandated flat price. We're going to dive a lot deeper into it, but at the very simplest, that's what it is. So, does it apply to different companies, different inventory levels, different basins, different commodities? Does it need to be integrated with the financial statements? All of those things, yes, 100%. And SMOG is not the only investing criteria that I use.
And I think that's partially where people are saying, hey, you're just using this metric.
Yeah, well, and that's true. And I guess let's also take a step back. I am a investor. The home office, the Ramsden Wood family office. It's not a big number, but I manage a portion of that, and I invest in energy stocks. And unlike someone who's paid fees, a 2 and 20 or whatever to manage other people's money, I manage my money. And to me, if I don't like the valuation of a stock, I don't need to be in the sector. I don't need to own a stock. I want to own stocks that I can sleep at night, because like every investor and every person who's listened on this podcast who has shares through their work, who has bought energy stocks because they feel cheap, I have lost a fuck ton of money in the last 5 years betting on energy stock. The worst one I had was I owned Anadarko pre-Chevron merger. Did you know that?
I didn't.
Yeah, I wasn't.
I can see it completely though.
I wasn't using the SMOG methodology. I was just using my gut, and I said I like the assets. I think Anadarko is going to get bought.
Yeah, you're using what everyone else was doing, right?
Exactly. So you know what happened is I think it was April 11th. Is the day they announced the deal was April 12th. April 11th, I noticed that Concho, who also I was using my gut because I love the Concho asset. It's not a value statement. I like the Concho asset. They're in 2 basins. They're in the Permian. I've made the comment the Permian's the only thing that matters. So what do? I buy Concho stock, and I had to fund it because Anadarko was flat and Concho was down 5% on April 11th. I was like, oh my God, I got to do it. So I sold my Anadarko. I bought Concho. And the next morning I woke up to discover that Anadarko was purchased. And so I was on the other side of the trade of the guy that was selling Concho to buy Anadarko. That was a painful day. But this was pre-SMOG. This was gut. And then, I expected a wave of consolidation. Concho had the Dominator pad. I mean, that absolute fiasco. And their stock ended up trading from like 120 around that consolidation. They hit like 60. And when I look at the SMOG number, that makes sense. So I'm saying, why am I owning that stock? I got to come up with a better system. SMOG is part of that.
So, and I'll do the producer business here and throw out a disclaimer yet again for everybody out there. We are not advocating. This is not investment advice for anyone to follow. This is just a dialogue around David's methodology, valuation. Because I do think that when you say, hey, valuation metrics right now are broken from the institutional investors, at least that's the way it seems. I mean, I know, personally know institutional investors who've literally told me, I'm getting out of this. I'm tired of getting my ass handed to me. And I'm done.
Yeah. I mean, and it's been brutal. And so how do you solve that problem when let's talk through my theses again. That's not feces. We can talk through that, where that is theses. My thesis is, number one, there are too many E&P companies. We need to consolidate. Therefore, mergers have to happen. We talked about that on podcast number 1. I'm not going to belabor the point. Number 2, I strongly believe that we are at the peak of U.S. oil production, and we will decline from this month forward and from the last month forever. And it's partly capital discipline. It's partly the ceiling on price that's provided by OPEC. If we go above 65 or 70 WTI, you know for a fact that OPEC is going to open up the taps because they've restrained 2 or 3 million barrels a day. Iran's off the market. So there's a ceiling, but the crisis of balance sheets means every single spare dollar needs to go to paying off debt because these companies are poorly capitalized. So I just do not think, plus parent-child, plus spacing, plus inventory, I don't believe the U.S. can grow oil production. So if we are the marginal barrel and oil declines, then oil price has to go up. So I have a personal long, and thank you, Glenn, not investment advice. I am personally long the ETF USO because I don't believe the back end of the strip is correct. It is a commodity bet. That is what I'm doing. That is how I'm playing it. So that's that.
Okay. So, I'm going to switch gears a little bit. I mean, like going back to what
Twitter?
No, well, not yet.
Okay, I'm ready to go. Come on.
Well, no. So, again, so at Entercom, for example, we would talk about, our 5-factor model. So sort of our value drivers that are associated. And those were when we would look at that at companies, we would say, all right, well, what are those 5 factors? That's what are the levers that management can control, right? And so that would be like your 3-year F&D cost,
Yeah.
right? So dollars per BOE, your OpEx and G&A, you can control that.
Yeah, 100. Yeah.
So
G&A for sure, OpEx to a lesser degree, but I mean, as we talked about with Chris Callinan on the episode earlier in the week, automation and headcount reduction and efficiencies can certainly help LOE to a degree. I'll give you that. G&A is really the biggest lever on that, but carry on.
Yep, fair enough. No, capital efficiency, and then like 3-year production replacement. These were things that. And then, of course, your debt to EBITDA, right? You can control your debt to a certain extent. Would you agree with all of that?
Yeah, I would. I would agree with that, certainly. And the overarching thing on this is the number one important thing, beyond management, beyond staff, other than price, is you better own the right rock. So capital efficiency is driven by rock, inventory, and spacing decisions. So yes, all of your points, but boy, if you own the wrong rock, you are fucked.
Yeah, and fair enough. Yeah, exactly. And all those are sort of as measured against price to cash flow per share. Now, I guess my question for you would be, are those invalid to you in terms of when you specifically are making an investment decision?
Yeah. So in this start, I'm gonna digress just a moment.
Okay.
Because we have some time, and I'm really excited about this episode, but I'm really excited about what the podcast is going to do. We're going to have every range of CEOs, and we're going to have charity, and we're going to have human interest stories, and sometimes we're just going to get on the mic and respond. And so this is one of those times. To me, yeah, I'm telling you. So, like, here's the facts, right? Every year, the company, who is employed by technical professionals who do this for a living, unlike the anonymous people on Twitter, they go in and they run a business model for the next 5 years. They look at their inventory. They look at what they can do. They know what the working interest is by well. They know what the CapEx is within reason. They know the LOE, and they build a development model. They run that through some very sophisticated reservoir engineering package, whether it's Aries, which, I mean, again, if you're using smoke signals, you should be using Aries. There's a lot better tools out there. Hashtag Value Navigator.
Everybody uses Aries.
I know everybody uses it. I mean, like, talk about Luddites. Anyway, so you run this model. You run your PDP, the SEC tells you what price deck to run, and you have a 5-year model. And then you publish the PV10 in your annual report. Now, is PV10 the right answer? No. Is it all of your inventory? No. But does it actually model a view of the next 5 years in a much better way that someone assuming working interest, assuming net royalty interest, assuming development pace, assuming inventory, assuming spacing, that doesn't actually work at the company and doesn't have the data? Yeah. Now, the reason investors and companies haven't pointed you to that before is because they say in 95% of the cases that companies are trading too high. Now, is this a perfect answer? No. But like, if the number that comes out of SMOG says you're $40 a share and you're trading at $100 a share, for the last 5 years, does it make sense that your stock is starting to trend down to the intrinsic value that you yourself publish in there? If not, it means most of your inventory is probable or possible, which means it's not proven, which means it's risky, or you don't have the right pace to bring that value forward. I don't need to own your company. You can go raise money elsewhere. But I'm telling you, the reason your stock is falling is because you don't have the underlying core asset value that's backing your shares. So I did that for 75% of the companies in the industry, but the ones I follow. And I found 3 that I think are worth buying in addition to the other criteria. And so that's what I bought.
Were they all large caps?
I mean, they're large-ish caps. The 3, I mentioned it on Bloomberg, so I'll say it again. I'm not a stock picker, and the great thing about going on live TV is I really have no idea what I'm going to be asked. And so I became a stock picker because I basically said what I'm personally long. And I am personally long Centennial Development Resources, CDEV. I am personally long Callan, post the acquisition, not pre the acquisition. All these purchases have really been since November. And I'm long PDC. And in all of those cases, the three driving criteria are they trade at a discount to their SMOG at year-end 2018. In the end of February, we're going to get 2019 numbers, and I will update this for every company. And if they're trading at a premium to SMOG, I will sell them.
How are you updating these numbers? Out of curiosity.
Yeah, so
I don't see a Bloomberg machine here.
No, yeah, this is the age-old Excel, which I always laugh when companies want to like automate their processes and they want to integrate all their systems and get things off Excel. But like Excel is the greatest tool known to man. I think some of you know this, but I actually asked out a girl in engineering via a macro I wrote, and I emailed the file.
You're such a dork.
I am a dork. She did say no. I guess that's not surprising, but I use Excel, and so if you look on the website, there's an archive under financial accounting, oil and gas, I think is what we call it. And there's the series on how do you read a balance sheet, how do you read cash flow statements, and what does this SMOG mean? So I have a spreadsheet that basically starts at the top and says, okay, how many outstanding shares are there?
I guess what I'm trying to get at for everybody out there. In other words, I don't want
people... Can everybody do it? Yeah.
Right, exactly. Yeah. You're not sitting here like some day trader, watching the Bloomberg as the numbers tick through. I was just trying to let everybody know that.
Yeah. No, that's right. That's why producer Glenn, he's here to keep me on track, and that was a very good track. But no, you go through their. You open up their 10K, you hit Control F on your keyboard. It searches a PDF document, and you search for the word standardized, and you look until it tells you what the 2018, and in a month it'll say 2019 what the SMOG value is. So that is the NAV PV10, not including any G&A, not including capitalization, not including debt. That's just a 5-year vision of the future. And it shouldn't change that much if you don't have reserve write-downs, if price doesn't change that much. And if it does change, they reconcile that for you every single year, which is great.
But doesn't that discount sort of what management's quarterly updates are going to be giving you?
Well, so let's call a spade a spade. Nobody believes management. The core argument on Twitter, for the record, of why you shouldn't use this methodology is because the view is management are crooks and management is fraudulent. And to me,
well, at least they're incentivized for themselves as opposed to you as an investor.
Right, but everyone's incentivized. Like when I go on Bloomberg, I'm incentivized. When I do hot takes, even though I don't get paid, I'm incentivized because something comes out of it. And for me, it's personal joy. But for other people, they're talking their book. They might be long, they might be short. Like news writes articles to sell ads. Like everyone is financially incented, and every industry executives have some sort of alignment with compensation. So can they play with numbers? I guess. Do I believe they're fraudulent? No. Do they push some numbers? Yeah. But like the whole industry is in my view pushing them to the same degree. They're using the big four auditors if you're a big company. Netherlands Sewell, Colley Gillespie, DeGolyer McNaughton, who else would we think of as big reserve? Ryder Scott. So let's just assume those four guys are doing an audit of the reserves of like all the companies that we pay attention to, and maybe they're all pushing it in a direction, but on a relative value basis, is it right? Yes. If management are crooks and their SMOG number is a total lie, they should A, go to jail, and at B, very least, they should be fired, their board should be fired, and they should be rolled up. Like, so let's take fraud aside. They're publishing their own freaking numbers.
Yeah, and I selfishly, not selfishly, but for myself, I'm a little conflicted in when you first started, saying, "Hey, Glenn, this is the what I use," and I'm thinking to myself, okay, you're just not going to look at EV to EBITDA or whatever. Is that really the way to go? And you were I can't find it here. It's on Twitter here, but somebody was accusing you of being reckless or something. And,
I'm somehow SMOG is the worst useless method. That's a simpleton's method, but at the same time, it's reckless to point people to these numbers,
which is public.
Which is public. So amazing. And again, like I'm not.
But I've struggled with this in terms of because I've listened to the investment advice, and I'm not the sharpest guy out there, especially when it comes to investing. I freely admit that I'm not good at it. And I've listened to the quote unquote so-called experts for the past 5-10 years.
Yeah.
and I'm getting my ass handed to me. So I'm thinking to myself, okay, well, everyone's got a model and everyone's got the right way of looking at it. And yet still, and I even showed this in my presentation at Intercom in the opening day of the conference, the industry probably does have a well-deserved acknowledgement of being destroyers of capital.
Yeah, I mean 100%. When you outspend your cash flow every single year, and you say, "Don't worry, we'll get cash flow positive next year,"
But all the models out there, from an investment standpoint, they didn't help me.
So, I mean, look, my very good friend Brandon White, he says it, I say it. We've sort of we're going to jointly claim this statement, but the industry itself is very simple. It is like one of the simplest industries. It's complex. It's capitally intensive. But you own land, you know what the wells are going to do based on the offsets, you have a view on spacing, and then you just run a model of how you're going to drill those wells. It's just not that hard. So to me, when analysts who are, let's call them what they are, no, actually I'm not. I don't want to make the whole analyst community get mad at me. They look at ways to justify positive ratings. I would argue that an analyst would be punished if they came out and said 95% of E&P is a sell, except for these three names. They're not going to get invited on conference calls. They're not going to be asked to go places. And at the end of the day, they're going to lose their job. So you can talk about Chinese walls all you want. Very few people can actually say what they think or what they know. And then really, that's why the hot take took off, is because I was saying what everybody else in industry was saying. Right. I just happened to say it on a social media platform that gave people credibility to be like, I'm not crazy, this is real. So, for example, when you bring a well on at 1,000 barrels a day, you know that within a year, it will be producing 200 barrels a day, 80% first year decline. And, you're going to get 25 or 30% of your reserves produced in the first year or so. And that's where all your cash comes from. So walk me through how some sort of comp, debt to EBITDA, blah, 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 matters when I actually have the model of what that well's going to do, and they put it in SMOG for me. And if I want to get really creative, I can build a little sensitivity so that if oil price goes up $3, I can scale the value. Or I can just do it for all of the companies in the industry, which excludes Exxon and Chevron or Oxy, because they have chemical businesses and refineries. And again, I don't own those companies because I can't value refineries. That's not what I'm good at. I don't own midstream companies because I can't value and I can't see the value of the product going through the pipe. But for E&P companies, simple E&P companies like CDEV, I can see it. And they tell me that as of 2018, they're worth $2.48 billion. Their debt at Q3 was $1 billion. So I take $2.48 billion, I subtract $1 billion, I divide by 280 million shares, and the number is 528. They don't trade at 528. I mean, that's as simple as it can possibly get. And then I say, well, okay, do I like their asset? Do they have low debt? Are they doing some right things? I mean, should they be not outspending their capital? Yeah. But on the relative, should they be bought by someone? Yes. And whoever's going to buy them trades at 200 or 300% of their SMOG value. So I think you could pay a pretty big premium on CDEV, and it's accretive for whoever buys them, in my view. Uh-oh, he's looking at Twitter. He's digging deep. He wants to get me pissed off. Because I was pissed off. I mean, I was at a high school hockey game, and I'm watching now. In fairness, my son he's playing varsity hockey. He's a freshman. And he gets 2 shifts in 2 hours, and they last about 14 seconds. So in fairness, I've seen enough. I've seen 300 games of youth hockey. I've been coaching for 8 years. I have 2 boys that play. I've seen enough hockey that I really don't need to watch the hockey. But I was sort of trying to watch, and I'm getting yelled at on Twitter.
They weren't all yells.
No, some were screams.
Okay, sure. I'm looking at one here, and this seems to be relatively nice. I won't say nice, but specifically this person saying, hey, it's a trust the SEC disclosure versus do your own work with insufficient data question. I think a combo of both, plus looking at management track record, beware of the MBA strategy here, should yield some good candidates.
One couldn't agree more.
See?
Couldn't agree more.
So that was a good one.
That was it. Whoever said that, anonymous person, well done. I like you. You can stay anonymous.
Well, I can give you the handle if you want.
No, we don't want to call out anonymous people. We don't want to do that.
So then that was followed up by somebody else going, there is sufficient data. Calculating PDP from quarterly net production plus public well data for the decline profiles. With acreage data and well data, you can determine how much acreage is left to drill. That takes some time, but worth it. Otherwise, you're just trusting management.
Right. Okay. So let's break that one apart, because that is a fair point. You're just trusting management. If you don't trust management, don't own their stock. That's pretty simple. Number two. Okay. So you don't know the working interest by well, and maybe you can guess it, and maybe you can back into it, and maybe you can come up with a better number than management can. But I mean, like, I've worked at big public companies. I've worked at medium public companies. I've worked at private companies, and it takes a village to calculate these numbers. So cool. You sit in your office, can do better assumptions than the team working it, and your assumptions are better. And in a vacuum, you can say, okay, well, here's my value. I don't want to buy the stock. Cool. I can do that in 6 minutes a company. So while you're calculating stuff, I'm going to be golfing, and I'm going to look at my spreadsheet, and there's 3 companies I can own. I mean, like, we're not talking a big universe, and I've said what they are. So I own them, and at some point, they're going to either trade up, all their peers are going to trade down, or they're going to be bought at a premium. And when that happens, I will make money. And if it doesn't happen, presumably, I won't make money, and then my investment thesis was wrong. I mean, I'll accept that.
Yeah, sure. I've got a couple more questions on this one, but so again, because I'm simplistic and I can look back and I can go, all right, well, like, I'm a fan of Geopark, okay, and I'm really a fan when their 3-year return is over 300%. So for me, is a very simplistic position. I'm like, okay, they're doing it right, they're doing it well. Now I have not done the SMOG analysis that you have, so I'd be curious to see what your data would illustrate for a company like Geopark, because I like management, I like what they're doing, I like where they're at, and actually the same for Talos. So again, okay. I'm not offering investment.
No,
I'm not,
right.
But I'm just saying
we don't do
I like the returns is all.
I love this. Okay, and so for you, this is going to be a 4-second pause. For us, and Glenn, I'm going to ask you to do this. I'm going to show you how easy this is. We're going to pause. I am going to do the PV SMOG analysis on both of those companies. I have not done them. Glenn can confirm. And he is going to time me. And then we're going to be able to have a conversation about those 2 names, which were not prepped for this podcast. Sound like a plan?
Yeah, I totally threw that out there for you.
I friggin' love it. Let's go. Start the timer. Hit the pause button.
All right, go. Okay, Mark. All right, so
didn't that feel very quick?
For the listener, perhaps, yes. Actually, it was fairly. I'll say this:
it must have been painful watching you having you watch me just grind.
I wasn't watching you; I was checking my email.
Oh.
And so, for the official metric out there, it was 11 minutes, and I threw you 2 companies, and you didn't know about that, so I'll just make that clear. So it was Talos and Geopark. These are both companies that are about $1 million. Slightly less than $1.5 million market cap.
Million? No, they're bigger than that. Market cap.
I'm sorry. I'm billion. I'm sorry.
Yeah. So we have Talos market cap 1.5 billion,
yeah,
and Geopark 1.2. And
okay.
And before we go in, so I don't follow these companies. I know nothing about these companies. Right. I think I've heard Talos, if I'm right, they're like they're offshore, like Africa, right?
Offshore Gulf of Mexico.
Okay, offshore. So they're an offshore company. I pay no attention to them. And Geopark, just from scanning their report, looks like they're basically like South American, yeah?
Yeah, I threw you a curveball. They're an international firm, primarily out of South America, exactly.
But the cool thing is that both of them trade on the New York Stock Exchange, so therefore they're subject to SEC rules, and therefore this could fit. So knowing nothing about the companies before.
So you've had 11 minutes go by as you dicked around with looking everything up, and I shouldn't say it that way.
No, I did.
You were very, you ignored me pretty completely and just went about your business. So my question for you is, and you haven't told me this, so everyone out there, this will be a surprise for me as well. What do you think?
Yeah, it's okay. Let's start with Talos. And again, I want to make the disclosure. If I got some of these numbers wrong, I would not usually be racing like this to do it. But it's not a very difficult method, so I'm pretty sure I know how to read balance sheets. For listeners out there, if I did get it wrong, please, email me and I'll make a correction. But so here's what we know about Talos. Thanks for joining. Talos, 54 million outstanding shares, currently trading at $28.31. Net debt of $697 million as of the end of Q3, which interestingly is $12.91 a share in debt. Their cash flow from operations in the first 9 months of the year was $332 million. Cash flow from investing was $400 million, and cash flow from financing was $17 million. The balance doesn't make a tremendous amount of sense to me, but the cool thing is, in my valuation methodology, that doesn't really matter. So G&A, $17 million, interest, $23 million, which means that G&A as a percentage of cash flow from operations is 16%, and cash flow and interest as a percentage is 21%. The other interesting thing, and the number doesn't feel right to me, but it says their interest rate is 13.3%. So if I was going to dig into this company, which I will do after this podcast, it looks like they have some sort of like very high yield instrument in debt, just based on the fact that their run rate on interest per quarter is $23 million, and they only have $697 million of debt. So it's either they have a very high interest rate, which means the banks view it as risky, or alternatively, there's some pref debt out there that I don't see from the balance sheet, and so it would make me dig in further into what's going on that, because most of their peer companies, again, this is a slightly different one, but I'd expect interest rates between 4% and 6%. So that's a surprise.
Red flag for you.
Red flag. So their SMOG is $3.34 billion, which just you take SMOG less debt. That means that their unadjusted SMOG PV10 is $48.94. They trade at $28.31, and that would mean that they're currently trading at 70% of their potential SMOG NAV. Now, as part of my method, there's two other criteria I add, because SMOG is just the asset. It doesn't include the capitalization of the company, and it doesn't include the G&A of the company. And so just as a very rough run rate, I subtract 3 years worth of G&A and interest to kind of hit the asset with sort of like what it would take to run it out for half of the 5-year period. And in that case, their NAV would be like roughly 40 a share. And so trading at 28, that would be an interesting look. And so, as I said,
interesting to you,
interesting to me. And I'm interested in what I'm missing on the interest rate. Obviously, if there's hidden debt, that's going to impact the SMOG less the debt. And, the cash flow numbers kind of don't look like they balance to me. But again, I did it in 5 minutes. So
literally did in 5 minutes.
Literally in 5 minutes.
Yeah.
So Talos would come up on my screen, and I would say, okay, that's a pretty interesting one to look at. I should probably dig in a little bit more. But,
fair enough. These are just mine that I think are interesting. What about you?
So GeoPark, 60.5 million outstanding shares. Market cap is about 1.2 billion on 435 million of debt is $7.19 a share. They trade at 1966. Their interest payment per quarter is 8.6 million, and their G&A is 14.5. So G&A as a percentage of cash flow from operations is 24%. That's quite high. And interest as a percentage of cash flow is 14. Their effective interest rate is 8%. The SMOG is $1.784 billion, which works out to be an unadjusted NAV per share of $22.30. They trade at 1966. So they have a slight discount relative to what they're trading at. When I adjust for 3 years of G&A and interest, I would adjust their shares down to roughly 1772. And so I'd say that they're trading basically at their NAV PV10 for all intents and purposes.
Okay.
So if these, again, I haven't looked at their stock performance.
Right. Agreed.
Didn't even look at, I have no idea what they did. But my expectation is that if GeoPark had been trading low, it's not surprising that they have traded up to their NAV. They're trading about their NAV. I'd have to look at peer groups internationally to understand where they trade. For US E&Ps, they generally trade at between 150 and 200% of their SMOG NAV. So, apples to apples, you'd expect that this could trade up to that range. And then on the Talos basis, again, I don't follow a lot of Gulf of Mexico players, but I would not be surprised if Talos had good performance over the last year based on that fundamental math. How did they do last year?
Yeah, again, I don't have it right in front of me. I want to say they're in performance range of upwards of 49-50%.
Oh, yeah. Talos, last year, Talos is up 51%.
There we go.
Looking at the rbcrichardsonbar.com site, little call out for that. It's the site I look at every day.
What about Geopark? This is maybe in the 40?
Geopark, I don't think is on RBC.
Okay.
So
I think it was
RBC,
around
you might want to
40%
add.
or so.
You might want to add that. But yeah, of the two companies in the last 365 days that are categorized as small cap by RBC, Talos is up 51%, Comstock is up 16%, and every other company is down. As an interesting little data point.
Yeah. Okay. Well, so, I appreciate your going through that. For our listeners, I don't know, you didn't get to see all the action on that one, but as you were going through that, and
oh boy,
no, I'm back to Twitter now.
Okay, good.
So this is one of your critics.
Of which there are many.
Of which are literally the verbatim is, the only reason people are talking about SMOG is because nobody can believe a seemingly sane person in the business world use it as an investment metric when it's so clearly useless. All it does is signal you may not understand how to evaluate an oil and gas company. Comments?
I mean, look, everyone's entitled to their opinion. And, I mean, I don't, I guess, know how to value oil and gas companies. I
would be curious.
I have so much that I really want to say, but what do I get out of responding to that? I put my views out there every day for people to read, and I use my real name, and I say what I think. Maybe I'm wrong, maybe I'm right. I guess the good news is I'm not trying to please anyone. I'm just out here, doing my thing, and I would like to think that my career track record, kind of suggests that I know what I'm doing in oil and gas. But again, I mean, maybe I don't, and maybe this guy's also just like exactly like me and not anonymous, and he's been crushing it in energy stocks over the last 5 years. And
I would really like to know,
independently wealthy and retired, and
what his track record
uses an anonymous name because even though he's not afraid of anybody, it just seems like the right thing to do. Maybe we'll go with that.
Yeah, I just want somebody that is going to, and maybe we can find somebody we can get on the show who can come in and go, you know what, David, you're full of crap.
Yeah, I love that.
And they've crushed it for themselves for the past 5-10 years.
Yeah, I mean, that's exactly right, Glenn? I mean, it's all well and good to call everybody out and say you're the best golfer in the world, but if you're not on the PGA Tour, I know who the best golfer in the world is. Like, they have a world ranking. So, yeah, I mean, look, I'm pretty excited about this methodology because it's simple and it explains why energy companies are not cheap and why their stocks have been falling, and like why I look at RBC in the small cap, and in the last year, 2 companies are up and everybody else is down.
So do you have what's your bias? Is your bias more towards these large cap firms, mid cap, small? Because you look at small, because you didn't look at these before.
Yeah. I mean, look, I've said it, I've written it for over a year. If you're going to be in gas, the only basin that matters is the Marcellus. We talked to Chris Callanan about that today, and I mean, the Marcellus since 2010 has grown from 3 BCF a day to like north of 30. So if I'm going to buy gas, and Chris has made me open my eyes, but as an investor in public companies buying gas, I struggle because of long-term firm commitments, midstream commitments, off-balance sheet related transactions, and just natural gas is trading at $2.15. So it is a great commodity. It will be a great commodity. I don't own natural gas no matter what the SMOG says. I watch it. I do tend to own Permian producers because I believe that the Permian is the last bastion of economic performance in the U.S. and that the Eagle Ford and Bakken have played out their inventory. And so again, it's a PDP blowdown case, so I don't really own those guys. But I do own PDC, which is surprising because with Colorado regulatory risk, you would think I might avoid it, but they screen extremely well. I really like their SRC consolidation. I like that they're going to cut G&A. I believe they should trade out of the Delaware entirely with Oxy and pick up additional Colorado risk, if you can call it that. They're already exposed as you can be. I would trade their Delaware position to Oxy for more DJ, and then both companies get what they want. So PDC, to go do that for me, please. But I own PDC because of the valuation, and then I own Callan and CDEP. So clearly biased towards the Permian as the most important oil producing basin to me in the U.S.
Have you taken? I don't know. Is Hess in your?
It hasn't been historically. Hess is also a great performer. And so again, am I biased? I should probably do Hess. And as you know, one of the other criticisms on Twitter, and this is true, is that these numbers are, I put this in quotes, a year out of date at a different price tag.
Exactly.
Now, the two things that I would say is, all of these, like, you know, Callan and Centennial over the last year are down a lot. PDC is down a lot, and their SMOG kind of would indicate that if they were trading above it, they should have traded down, as all their peers traded down. But secondly, like, if you're running a real 5-year development plan and you're spending capital in line with the plan and you're producing cash flow in line with the plan, like, models don't change that much. I mean, this is what people forget about the oil and gas industry. They're like, update the model, update the model, update the model. There is no update the model. The rock is the rock. The type curves are the type curves. They don't change if you're not lying. Like, the reason OneEnergy was successful was because I had declined every horizontal well in every oil basin in the United States by myself. So I know in every township and every block and every area what the EUR per foot has been. I know that since 2016, with the exception of the Bakken, well performance in every other basin has flatlined. So completions are not changing the results. So I know what the EUR per foot is. I know what the IPs are. I can build type curves, and I know what the spacing assumptions are based on volumetrics. That's how OneEnergy worked. So, you know, again, it should never have come up on Twitter. It certainly wasn't me. But like, OneEnergy wasn't lucky. The way you have success in oil and gas is you buy smart. And the way you buy smart is you have really good assumptions and you do the work, and then you work your ass off. So that's what we did, based on me declining every single well in every single oil basin in the United States. So, you know, when you do that and you buy right, you end up doing okay.
Okay.
There we go. So, Emergency SMOG podcast. I hope it was enjoyable. You know, I don't want to come across as like, you know, angry or vindictive around the Twitter people. I get it. I like it. I was off Twitter since January, and I jumped back on in November because I see it as like a thermometer, is that when people are talking very negatively or very positively, it's sort of a sentiment indicator of what's going on and how people are seeing the world. And I think that that's very valuable. I think there's a lot of really good articles, and there's a couple people I follow out there that just post really smart, intelligent stuff, including the anonymous people. And so, you know, I'll give credit to the people who are being reasonable. I think it's great.
Yeah, and if I can just throw in there that this podcast is not intended to be defensive in any way.
Yeah, no, not at all.
And it really is an opportunity. I mean, if there are people out there that have say, hey, look, you know, you have your model, I have mine, and I've been working with, you know, whoever for X amount of time, and, you know, it's, you know, crushes it every time. Love to see it.
Yeah, love to see it. Yeah, 100%.
Because we can always stand to learn a little bit.
Yeah, I mean, look, this is the method. You know what I own. Some people on Twitter even know how much I own. And so, I mean, judge me. There's no pride. There's no pride.
Worry about that. People are doing that.
Yeah. So, I mean, you're going to see, I either did really well, and then everyone's going to say, man, I wish, even though it's not investment advice, that was really a smart theory that I should do for myself. And if I get crushed, then everyone's going to be like, look, you idiot. That's just the way the world goes. But, you know, that's how I'm investing the Ramsden Wood Hedge Fund. So there you go.
Awesome. Okay. Well, so what's coming up next? Are we in a position where we can kind of lay that out a little bit? Yeah.
So you know, on this topic in more of a granular dive into SEC reserves. We're going to have a reserve auditor come on and sort of talk through the methodology and sort of, give some color to what that process looks like. I think that's going to be good. Working on getting some commodity traders, advisors to come on to talk about how they see the market and how they gauge the market and how they interpret what they're seeing in terms of price action. I think that's going to be a good episode. There's a couple CEOs from companies that have recently sold that we're working on getting on the show. We'll continue with our 10-minute hot take over your commute to kind of catch you up on the previous week's news and be able to get to the office Monday morning with a little bit more knowledge. And then, viewers who or listeners who want to, have us explore concepts, shoot us an email, let us know what we want or what you want to hear. And I think it's going to be fun, and hopefully there's a good format. Hopefully it's educational. Hopefully it's entertaining, and we'll continue to grow. And listener input is the best way for us to give you what you want.
And so on that note, please submit any questions that you may have to drw@hottakeoftheday.com, and we'll be able to at least take a look at that and go through them and address them and throw them out at you as we go.
And I think also that's a good point. The website is up, www.hottakeoftheday.com. And on that, we've now got almost 100% of the archive posts. And so this isn't just stuff like revisionist history. Going back all the way to January 1st, 2019, we have effectively all the posts we've made. So you can go back and check my accuracy. We've tried to categorize it, and we'll continue to do that. If you like what you read and you want to make it easier, subscribe to the email subscription. We have some exclusive member content where when we do presentations, or when I go on Bloomberg, I send out the notes that I've prepared in advance of that, so you can see sort of the process of how I'm thinking, including this SMOG spreadsheet that I have. And I think that's it. If you haven't read the book, get the book. That's how we're paying for this right now. It's book sales. We're almost across 600, which means I'm going to need to change the cover. Because the cover currently says less than 600 sold. And so we're going to transition that to slightly more than 600 sold when we get there. And at that point, we will release the Kindle. I've had some requests for Audible.
I was going to say there's money involved in this.
Oh, yeah. Well, there will be eventually. I mean, there's, a little self-funded hobby project. I think it might be worth just to really plant a hook line. I'm going to do a dramatic reading of the first chapter of What the Fuck is Wrong with Everybody Else? What do you think?
Chapter by chapter.
We'll just do chapter 1.
Chapter 1 will be short.
Okay. Chapter 1, losing weight. Eat less, exercise more. Yes, it is that easy.
Boom.
Chapter 2.
There we go. Nicely done. Also, a shout out just to Hot Take Nation. Thank you very much for listening. Thank you very much for being a part of it, contributing and weighing in. I know that you've got a lot of people that respond to you on LinkedIn, and that's fantastic. So just really appreciate all the interaction. And I know I'm the one saying it, but it's really you're the one who's, they're talking to.
Well, with that, be safe, be good. Have a great week. Bye for now.